Hey guys, Kill here. Welcome back to another midweek markup. A quick video showing you one of the trading opportunities that is on my radar kind of midway through the week here. If you guys are brand new, make sure you subscribe to the channel. Do me a favor, hit that like button if you like these quick little videos. I want to start off before we get into our euro dollar setup by just giving you a heads up of what's on the news event radar for the week ahead. This is a jobs week here in the US, right? So we're gonna have the ADP non-farm employment change coming out tomorrow. This is typically looked at as the precursor to Friday's job numbers. However, recently that hasn't been the case. And on Friday, or Thursday, I should say, we have Governor Bailey speaking for the Bank of England. And on Friday, we have our jobs report. Now, the interesting thing about our jobs report and ECB president speaking is that this is also a holiday weekend here in the States. So it's going to be interesting to see. Usually people travel and get their July 4th adventures going a little bit early. So it'll be interesting to see how much interest is actually there in the market. And if we know if there's lower liquidity, we could see some more vicious movement in the market. So this may actually be a very interesting event here on Friday. Now, what I want to show you today was a setup on the euro dollar that we were tracking here in the live trading room, not here in the live trading room, but earlier today in the live trading room. And this is going to be a sneaky double bottom, non-double bottom. And what I mean is this, right? If you've been following me for any bit of time now, you've probably heard me say something like, the what is not as important as the where. And I think a major problem for many traders out there is that we fall in love with the what. So we fall in love with understanding like a pattern or a setup, like a flag pattern, a head and shoulders, a double top, and AB equals CD, right? These are different kind of classical market patterns, right? Repetitive patterns that happen in the market over and over and over for all eternity. The problem is that I don't want to say they're not important, but their importance comes from where they occur at, not actually what they are. So in front of you, you can probably see a potential double bottom setting up, right? You see the market come off a very nice directional move from 122.50s all the way down to about 118.50s. You see a brief retracement right here, and you're looking at this and you're saying, man, if we come down to test this level, this is going to be a beautiful double bottom. And it could be, right? We have the RSI oversold on the first attempt. It looks like if we get down there, we may have a chance of having bullish divergence, right? All signs that line up for a good double bottom. The only problem that I have is the overall location. I'm not really a fan of it. Now, yes, you can make the case for some minor levels of structure, right? You have some inside structure right here in this little swing point. You have a little bit of consolidation right here in the form of a previous ascending triangle before we broke out to the upside. So there is minor structure level there. I'm not saying that it's not a bad place to look for an opportunity, and looking for a double bottom is definitely better than, just putting a limit order down there, looking for a single candlestick reversal at that point. However, I do think there is a better opportunity. I think that better opportunity is going to come a little bit lower at our lower VS1 level, down around the 117 level. And in fact, if we take a Fibonacci extension from our swing high to swing low here, I think we're going to have a 127 right around that area. Yeah, right around a little bit higher, not 117 even, but about 117.33s. I think this is the better opportunity to look for a buying opportunity. Now, you still got to be careful. And we can talk about this a little bit later because we have another underlapping level of structure down here, which would be even more important, but we can visit that at a later time, maybe in this weekend's video. But I think this could be a sneaky level where a lot of people are going to be interested in longs. I think this is a perfect place for the price to push through this level, break out, trigger those stop orders, and push all the way down to here. So something that we've been watching here on the Tier 1 trading platform is not necessarily waiting for the double bottom, but looking for the break of that double bottom and a continuation down to that lower level of structure, 117 evens or 117.31. So that's something that's on the radar for this week. Again, it is going to be a tricky week with the jobs number coming out on Friday. If this doesn't occur before that, then I would wipe the idea clean and just wait till after the dust settles from the jobs report and reevaluate over the weekend. But if we can see this movement in the next few days, I think it is a decent opportunity for a short. But you know what? Let me know if you think. Let me know if you like this idea. Let me know if you have a different opinion. Again, one of the big things I'm about is community and not necessarily battling and arguing and yelling about who's right and who's wrong, because No one ever knows who's right and who's wrong, but sharing ideas in a way that we can all become more educated. We can all see kind of different sides of the story. And I think that helps us in our own view of the markets and where we're looking at for opportunities, where we're looking at for stops, where we're looking at for targets, and really just push us to become overall better as a trader. So let me know what you think in the comment section below. I will see you this weekend, not for a normal Trading Edge video, but for a special one. We're going to talk about the different types of orders, limits, stops, right? How to get involved in the trade. And of course, until next time, plan your trade, trade your plan. You guys take care.